Perfect. Okay, so thank you everyone for being a part of, again, our Virtual Connect 2026. For those of you who have been on the first few sessions, this is going to sound familiar of an introduction. We are thrilled to have 14 sessions over these 2 days, and we're asking our speakers to do yeoman's work by, covering a lot of content in 30-minute increments. So I'm going to be as efficient as I can to kind of reintroduce today's session and then turn it over to Gabriela Santos to really bring her thoughts on the economic landscape in front of all of you. So let's get started here and talk a little bit about the Advisor Network and what it is that we have formed and why we're talking to you today. So there's over 7,000 total wealth management professionals that have joined the Advisor Network community in the last 19 months. And over 250 of you have joined our interactive collaborative platform. I believe is 34 states represented and well over $155 billion of assets under management represented by the folks on our collaborative platform. And we are doing 2 to 4 webinars a month, really focusing on divided between advisor to advisor idea sharing and thought leadership from our institutional partners, like you're hearing today from our friends at JP Morgan Asset Management. From the live meeting perspective, 1 national and 3 regionals, with the idea that we do need to have the ability to see one another in person to augment what we're doing on the virtual scale. Some of those live meetings and virtual meetings coming up, of course, our TAN Virtual Connect, which you're a part of today, will be in Saratoga Springs next month in August. We'd love to have you with us for that. We'll be in Los Angeles area in Orange County in October, and our flagship in-person meeting November 10th through the 12th in Las Vegas for the Advisor Network Connect 2026. But most of you did not come to hear what events we have coming up. I'm excited to share and bring to you Gabriela Santos. And so just a really brief update for Gabby. She leads the America's Market Insights team at JP Morgan. A number of you already received some publication she's been deeply involved in working on, which is the Guide to the Markets. And I didn't realize, Gabby, how many versions of Guide to the Markets there are, including Latin America and Asia and some other places like that. And in addition to you joining us today, we know how many different economic programs you are part of, whether that be CNBC, Fox, Bloomberg, etc., in terms of all the time you spend in doing that. So, Ashanti, I'll invite you to share your screen, and I'd invite Gabby, please, if you join us, and thank you for being a part of what we're doing today. Before you get started, just a quick note, we are using the Q&A function on the webinar. So if you have a question for Gabby, you can use the Q&A function. Otherwise, a number of you have already sent me emails and text messages throughout this day with questions. You're welcome to do that too. But Gabby, without further ado, over to you.
Thank you so much. And indeed, we now have the Guide to the Markets, 7 versions, 12 languages in 42 countries. I will be using our US version, the original, to talk through our outlook, which we're calling Divergences Amidst the AI CapEx Surge. If we go to the agenda on the next page, I wanted to take a minute first talking about the economy. This whole AI CapEx story is having a big impact. We're also seeing a lift from upper income consumers. Talking about equities, where the climate still very much favors AI, but we're just in a new season of it. International, very much part of the AI secular story, much more than any kind of cyclical theme. Fixed income, a bond market that has repriced and is now priced for inflation and a Fed hiking rates. And then alternatives or private markets, a way to think about diversifying the offense and the defense. Getting into it on the next page, in terms of the economy, there's a lot of ups and downs here on the right-hand side, a lot of volatility quarter by quarter. First half of last year, we saw Liberation Day, the announcement of big tariff changes that created a lot of noise in the trade balance and in inventories. And then at the end of last year, we had the government shutdown, also led to some noise. So I like looking at the left-hand side, more of an annual figure of the economy. And there you can see last year we saw growth of 2.1%. That's a little bit of a step down from the year before in 2023, but we would call 2%, trend. So you're kind of an economy going on neutral here, growing around trend. The data that we've got in the first quarter of this year shows a similar pace, and then we'll get second quarter GDP coming up here later this week. We expect beneath the surface to show a similar pace again, so about 2% for this year. Now, the dynamics or the colors are getting interesting. Staying with the first quarter, the gray is doing a heavy lifting. The gray is business investment. And that's where you see this AI CapEx spending from hyperscalers showing up in the real economy. That is expected to do a lot of heavy lifting in the second quarter as well when we get those numbers. You can see it by leading indicators like the durable goods report that we got yesterday. You're seeing a surge in durable goods related to the whole AI CapEx build out. So computers, electronic equipment, semiconductors, and the like. Besides that, as we know, the economy is, 2/3 the consumer. That's the light blue share here. And there was a bit of a step down in the first quarter in the pace of consumption. It does seem to have done better in the second quarter, but I would really call it resilient. So there are a lot of offsetting dynamics for the consumer. We know the affordability challenges. And then, of course, we had rising gasoline prices due to the Iran war and the closure of the Strait of Hormuz. That's ongoing. But the second quarter did see a benefit of tax refunds. The other really important dynamic looking beneath the surface is that there's still a lot of heavy lifting that's being done by your more upper income consumer, the top 20% income portion of the population. And so especially strong in things like travel and leisure, people taking cruises and going on flights around the country. A lot of that is being led by upper income. Otherwise, I would say it's a consumer focused on essentials and discounts and trading down, resilient overall. We look at the next page, we also, besides the economic growth rate, love looking at the labor market, the first side of the Fed's mandate. And here we have good news on the left. Last year, very stagnant job creation. This year, an acceleration, really a normalization in the pace of hiring. We see here a 3-month average is now about 111,000 jobs added a month. That's good. It's not booming like it was in the heyday here of the pandemic time period, but it's good. It's normalizing. Importantly, thinking about the other side of the Fed's mandate inflation, we look at the right-hand side wage growth. That's the light blue. Very, very strong in that peak hot labor market period post-pandemic, but it's really rolled over and normalized to what it used to be pre-pandemic. Now, as a worker, that's bad news. But from a pure economic perspective, it means that the labor market is good, the economy's fine, but it's not inflationary. So taking a closer look at inflation on the next page, we did have some disappointment for 3 months there, where we can see the trend was moving in the wrong direction. Inflation reaccelerated for 3 months, March, April, May. A lot of it driven by those higher gasoline prices. That's the green contribution there, very large. But it was more than that. If you look at the other colors, especially the light blue services, that started accelerating again. And that's what got the attention of the Federal Reserve. Big relief. Last week, we got June inflation, and now we're back to trending in the right direction. So a deceleration. And importantly, it wasn't just gasoline prices that took a breather in June, but it was everything else as well. So now we feel a bit more confident that we're going to continue seeing this normalization in inflation. Towards the end of the year, we expect overall inflation around 3%, and then next year to get closer to 2%. The big question now is how patient the Fed's going to be willing to be. Tomorrow, we've got the Fed meeting, and when we look at the next page of what's priced in, that's going to be the green. Market pricing is at the very, very tippy top of the range this year. The market is completely priced from rate cuts to rate hikes, including about a 1 in 3 probability that you could see rate hikes tomorrow. It's the first time in decades that it's kind of a toss up. We don't really know what's going to happen at a Fed meeting. That seems to be the biggest change under the new chair, Kevin Warsh. He likes to keep it a bit unpredictable, likes to see how the market is pricing things instead of the Fed holding our hand and giving us this very clear forward guidance. Now, we suspect that actually the committee is not as hawkish as it seems or as eager to raise rates. The dark blue is the dot plot or that median projection from Fed members. But it's important to remember that even though it shows one hike for this year, there are 18 members that submitted a dot, but there are only 12 voting members. And we can use large language models, AI, to look at the voting member speeches and try to see how worried they really are about inflation. And there we project that actually 8 out of the 12 voting members actually probably their dots showed an on hold position. So that's why ultimately tomorrow, the rest of the year, we think this is just a Fed on hold. Rate cuts are off the table, but rate hikes, you probably need inflation to move in the wrong direction again, which we don't expect. So more on hold here where we are. The midpoint is 3.6%. If we think about markets, moving on, going to one page after this one, there's been a lot of cross currents. We have two active wars, really, a lot of cross currents for the economy, for rates. But when we look at the very last column on the right, it's been a really good year for risk assets, especially for equities, really around the world. Emerging market equities stand out, up nearly 20%, US large cap up 9%. What's really, of course, disappointed has been core fixed income, now mildly negative for the year. And I think there are different stories there. Equities are very focused on, of course, earnings and the secular story from AI, whereas fixed income has really repriced the inflation outlook, the Fed outlook, and that's weighed on returns. Now, if we look forward the next 6 months, 12 months, we see an equity market that's still supported by earnings. If we stay on the previous page, still supported by earnings, but one that could be a bit more volatile given how well it's done in the first half of the year. So there's more a story of balancing the earnings with expectations. And in fixed income, that's had a tricky year, maybe has a better year. Better second half of the year as the Fed ends up not raising rates as feared. Thinking about equities on the next page, I really like to say that equities are 2% from all-time highs because of strong earnings, not a strong economy. Economy's fine, but earnings are so spectacular. When we look at the left and we look at earnings growth on an annual basis, the first arrow was pointing to current estimates for this year, on track for earnings growth of 28%. That's amazing. Third year in a row of double-digit earnings growth, which if you look here, we haven't seen since the early 2000s. And it's about 4 times your average earnings growth rate. Just truly spectacular. And it's coming from very good margins on the right, and also coming from very strong revenue growth. Now, this is, of course, being driven by AI, AI, AI. And that's where the next page is really, really important, looking beneath the hood across the AI supply chain. We can see on the right-hand side that when we look at the major AI-related groups, hyperscalers, semis, hardware, power, we also look at software, that's where you're seeing just extraordinary earnings. 45% for hyperscalers, 100% from semis. It's amazing. So very much boosted by the boom in the AI-related CapEx cycle, the whole build-out. So no question, the fundamentals are extraordinary. But the AI story in terms of performance has changed a lot. So very important to look at the left-hand side as well. What started as 23, 24, 25, a story about the hyperscalers. Remember the Mag 7? That group has really fizzled out. The hyperscalers are down actually about 9% now this year. The Mag 7, I would just like to say, is dead as a group, as a construct. And very, very quickly, the market is now really pricing in the benefit to following those CapEx dollars. So, to who's actually getting the money, semis, hardware, power, the picks and shovels. The other thing that's really changed about the AI story this year is it's not just who's doing the AI disruption, but who's being disrupted by AI. And their software still the poster child down 20%. Now, what does this all say to us? It says we can't just look at the fundamentals. We have to balance that with expectations and how the market has absorbed this whole story and how quickly it's changing. So an area we started getting concerned about in June is exactly the area that's done the best, semiconductors. Earnings are still amazing. It's just that you had the best quarter for semiconductors ever for decades and decades. So it's no wonder that since June 22nd, we've had about a 20% sell off in the group. So we're still very positive on semiconductors, on picks and shovels in general. I think it's just important to look at portfolios and think about what's the position sizing, what's the concentration risk there, what's the leverage that maybe some clients have to certain names that have done well, and just think about reallocating a little bit. The other thing we can do is look at areas that have actually been punished, and maybe some opportunity has been created there, namely software. The earnings have still been very, very strong for the group. That hasn't changed. The market has just maybe over extrapolated potential risks. So we see opportunities in things like cybersecurity within software, also certain companies within software that have really niche, vertically integrated software that's very hard to disrupt with some coding on the side. So really important to keep on top of this ever evolving story. On the next page, if we think a little bit about not just US equities and some of the churn there and active management that's needed, I think another year in a row where we've really seen the benefit of having a global equity exposure. Middle of the page, we look at 2025. The US had an amazing year, but underperformed non-US by nearly 1,600 basis points. 16 percentage points. It was huge. This year, the US is underperforming again by about 300 basis points. So that's true despite tariffs, despite wars. I think international is really proving that it's being boosted as well by exceptional earnings. That's the dark blue here across the board. And that it's being driven also by secular, not cyclical themes. What are those? On the next page, we can take a look at some thematic baskets just as a proxy for what's going on overseas that's different. And we compare it to a really hot area in the US growth. That's the gray. And you've seen just extraordinary performance. Of course, a big theme is AI and how Asia is intrinsically linked. That's the green, just lights out performance in places like Korea, Taiwan, especially semiconductors. Now that's in line with the US semi sell-off where you've seen a correction just driven by expectations. But Asia, many different companies are still just deeply linked to this AI story, the CapEx and the actual physical application of it with robotics. So still a really powerful theme, and the home of all of that being EM Asia and Japan as well. Besides that, though, I would spare a thought for Europe and Japan as well. Things like, take a look at the orange. That's Japanese and European banks. Lights out performance, basically double US growth. It's been a stealth secular theme. That's about the end of negative interest rates, the end of deflation, very, very similar profitability to US banks, but at a discount. Another big theme, the purple here, that's the fact that Europe has awakened to the need to invest in defense and its own infrastructure. So huge, huge theme for European aerospace and defense. Lastly, the whole world has opened up its eyes to needing to reward shareholders. So big increase in corporate governance changes, and that we proxy by the light blue here, which is Japan value. There's just so many interesting secular stories driving really powerful international earnings and really powerful returns that are much more insensitive to what's happening in the real economy overseas as well. Last point I wanted to close on equities on the next page is this idea of really looking at portfolios carefully beneath the hood and thinking about where maybe things are going to move together, where there's concentration risk. And here we show major markets. What's the share of the top 10 biggest companies? Still very concentrated in the US, about 40%, just 10 companies. A lot of them obviously related to tech and AI. Similar story in EM. About 40% are 10 companies and very tied to tech and AI. Actually, just three semiconductor companies represent about a third of MSCI emerging markets. So really important to think about US and EM as two sides of the AI story. They're not going to diversify each other. They're going to move very closely together. Also, extra important to think about active management in the US and in emerging markets. Otherwise, you're very concentrated in what's just worked, not where the AI story is going in the future. Last thing, really worth looking at Europe and Japan for diversification with other themes. If you look at that whole point about financials, that's the orange, much bigger share. Defense and infrastructure spending, industrials, that's the dark blue. That leads us especially to the value of Europe and Japan value to complement the growthiness of US and EM. Thinking about fixed income, not to be overshadowed by the amazing stories in the stock market. If we move forward a couple of slides and just think about glass half full of having had a tricky year for core fixed income, is that yields have reset much, much higher. So here we compare the yield curve today in dark blue to the yield curve at the end of last year, the light blue. And we can clearly see, especially the short end of the yield curve is what has repriced higher. The 2-year has moved higher by 85 basis points this year and is now full 60 basis points over the cash rate. So we really think more than ever it's beneficial to move from cash-like instruments to short duration. A lot of benefit from the income pickup, and maybe you can get some price appreciation if the Fed doesn't hike rates and then yields end up moving lower later in the year. Where we're a bit more worried still about volatility is in your longer duration, 10-year, 20-year, 30-year. There we still see the market focused on rising deficits and debt levels, and that's unlikely to change even after the midterms. The next page, looking across the whole fixed income universe, the Fed may be on pause, but the income in fixed income is not, and it's looking a lot more attractive even versus the end of last year. Just take a look at investment grade, a yield of 5.5 right now. That's the highest in a couple of years, as well as securitized debt, little over 5%. That core fixed income area we still very much like, especially exposure to corporate credit and household credit, where the balance sheet looks a lot better than the federal government's balance sheet. And then for your more extended part of fixed income, there things like high yield offering an attractive income of 7.5%. Thinking about portfolios again on the next page, let's not lose sight that not just is our portfolios probably concentrated in a few names, but probably in a few asset classes, equities namely. There's been just lights out performance there versus bonds over the last 5 years. So if there hasn't been good rebalancing, a structured rebalancing, what started as a 60-40 in 2019 could have drifted away from that North Star and have become a 74-26% portfolio. That's a lot more risk beneath the surface. So just the importance of using, especially tax aware strategies to take some profits, rebalance. There's still a role for fixed income to lower volatility and to protect against any recession risks when we eventually get a recession. Lastly, it's not just public, but also private markets. And the whole change in the behavior of stocks and bonds really leads to that private conversation. The right hand side, we show how unstable correlations have become between stocks and bonds. They work sometimes, but they don't work every time. There are times when the worry is more inflation, where their bonds don't work as a one-stop shop for diversification. So when we look across alternatives on my final slide here on the next page, there are certain areas of the alt universe, especially on the left-hand side here, where you have low or negative correlation to a 60-40. So areas like absolute return hedge funds, infrastructure, transportation, real estate, where you can really diversify the bond diversifiers. They're just natural inflation hedges. So really important. And then for the offense, it's where you're closer to the Planet 60-40 there on the right, where that's not diversification of portfolios, that's risk, it's private credit, it's private equity, venture capital, but it's there as a way to diversify from just pure public markets, especially venture capital, earlier access to the whole AI story, or private credit with important income pickup. Let's not forget, though, this whole alt universe is meant to be long-term investment. And that's what you've seen this year with private credit. It's semi-liquidity, but semi does a lot of heavy lifting there. It's not meant to be a quarterly liquidity profile. It's really meant to be for years and years. So just really important to keep that in mind. Another important lesson is that you can have radically different exposure based on the manager. You could have all software in certain private credit. You could have zero software in other strategies. So manager selection, extra important. Colin, I will pause here, see if there's one question we could tackle in 2 minutes.
Perfect. We do have a question I want to certainly pose to you. I want to remind everybody that there's a number of people who are going to be watching this afterwards. If you are looking at this and you say, "Can you send me the slides?" The good news is these slides are available to all of you in the guide to the markets. So if you don't currently have the guide to the markets, almost regardless of what firm you're a part of, please see when we send out the information after the recording of this is distributed. Please sign up. JP Morgan Asset Management does an amazing job. This information's updated so regularly, and it's great information. So that I get a lot of. I already got somebody saying, "Can you send me this?" It's available to you, which is the good news.
And
Um,
handy, Ashanti, if we go to the next page, I included little handy QR codes.
oh,
If you're live or recording later,
yep.
please, easy there.
Unbelievably helpful. So we'll make sure that this is highlighted so that folks can get to this afterwards, especially those that'll be tuning in a little bit. So there was one question that's come up in multiple sessions we've had today, Gabby, which is we're seeing a lot of headlines about the government in some way, shape, or form being spurred to limit AI, whether it's limiting chips, whether it's limiting our ability to use AI. Are you concerned about this, and what would the impact be to what we've talked about so far if that were to continue?
Yeah, it's so interesting because AI is, what policymakers call dual use technology. It's useful for just private day to day, but it can also be used in precision weapons. So hence a lot of attention from the government in this critical industry. We do see restrictions continuing, especially in critical inputs. So advanced semiconductors, critical minerals, and especially tied to this competition between the US and China. And China knows this at this point and is really racing ahead to become self sufficient in this. And we expect to end up with the world having two parallel AI systems, one led by the US, one by China, and then certain countries kind of choosing between the two. Big competition there. Besides that, we see more limited actual regulation of AI, whether it's models, there's kind of by a voluntary sharing of new models with the government, pretty light touch. And then when it comes to data centers, that any regulation is more happening at the state or local level. So that's where we're less worried about actual regulation with this current administration, this current Congress. But certainly you are seeing pushback from the population. And I think AI companies are realizing that they have a bit of a PR problem and they need to focus on bringing their own power when they set up data centers across the country, because there's a big affordability issue that voters are voting with their feet.
It's interesting that's come up twice in two of the three
Yeah.
sessions we've run so far. I think there's a healthy concern from folks, but I think your answer was great, and I appreciate you answering it that way. So everyone who is again live, thank you for joining. For those who are going to dial in later, please, the slide we just had with the QR code, if you're not already subscribed, please do subscribe to the Guide to the Markets. Our friends at JP Morgan Asset Management are wonderful partners. If you don't know who your representative is, obviously we can lead you in that direction. Please reach out to us. We're happy to make those connections for you. But Gabby, it was wonderful to spend some time with you. We really appreciate your insights today. And for everyone who has been dialing in and will continue to dial in for the Advisor Network Virtual Connect, we appreciate you being a part of it. So have a great rest of your day.